So I think that Europe started this. You know, the fact is everybody got on the same train because the ECB was buying everything under QE. So they all went long bonds. So you then had a positional issue that has led to a liquidity issue. And I think the point about Russia and Ukraine is valid as well. So everybody was looking the same way. They all try and get out. Then they get uncertainty in global markets. Is the Fed going to move? Are they not going to move? What is the data all about? And then ultimately everybody just says, I don't know. And when they do that, that's when you see markets get dislocated. And that's where we are right now. So I think what we need is a lot more evidence of data in the US so we know what the Fed's going to do. And we're going to get that. There's a lot of data coming out of the next week. Then we get clarity. Right now, people are just a little bit scared. But I'd say one more thing. 10-year approaching 2.3% represents something we haven't seen since November last year, and that is yield. And that is an alternative to stocks that I think investors are looking at right now.
3% sequential inflation is the normalization of oil prices coming back. I think we're in a world where globally inflation is going to settle somewhere around where it was in the middle of 2014. We're going to make a round trip. We're in a world in which the Fed is going to be starting to tighten. We're in a world in which the euro area and Japan are still going to have very low inflation. That does not require extremely high yields, right. But what we're doing is taking out the extremes on the low side we got into as we turned into 2015.
I mean, the pendulum seemed to swing a little bit too much to the negative, and now we're seeing a normalization. We're seeing a normalization in yields. We're seeing a normalization in oil prices. So I think the market's just been trying to digest that. And then they're looking at earnings because it always comes down to earnings. So the earnings outlook was negative at the beginning of first quarter. We're looking for negative growth. Now it looks like it's going to squeak by with a positive. So I think the market is just trying to digest that.
The U.S. is, if it hasn't rolled over already, is getting ready to. I mean, you've taken the U.S. rig count down by more than 50%. So we think production in the United States is going to start falling. You know, we're not big bulls on oil rising rapidly from here, partly because Saudi Arabia is apparently taking share. Not a lot of people talking about that. And if Iran comes into the market, that pushes the recovery in oil prices to a higher level further back. But the U.S. doesn't really work at below $50 a barrel. The oil sands don't work for any new oil sands projects below 70, 75. So we just don't think there's enough production growth out there once you finish Saudi's taking of share. And if there's a deal with Iran, Iran will have to come into the market. But that pushes an oil price recovery up towards 70 back by 12 to 24 months in our view.